So this is something I started a few years back. I remember at one point I was on the trading desk. I was going through a slump. You know, those times you just nothing's kind of working,
Mhm.
and it kind of got to the point where you're almost starting to get that nervousness to put on another trade. You know, you're in drawdown and all of that. And I had a good friend working next to me. He's like, "Look, man," he's like, "just pick a number you're willing to lose that's not going to even bother you, and just start trading again." And I said, "Okay," and it kind of got me going. And one trade leads to another good trade, and another good trade, and suddenly your confidence is back, and you built it up. But that was like a really good learning lesson. I said, "Oh, so I created this dollar stop concept where if we're given my current account size, there's a certain amount of money. I mean, we all like to work in percentages, but our mind works in dollars.
Yeah.
So I say, like, I'm willing to lose so much and it won't bother me." And that was a dramatic, it really helped me to always keep my stress levels down. And so it was such a step change in how I was able to deal with stress and the rest. I started this thing each year where I would pick what I felt was a weakness in my strategy, and I'm going to spend the whole year on purposely trying to improve that one specific area. So, not that we ignore all the other rules and the rest of the
Mhm.
strategy, but an oversized effort, an oversized attention to detail of that one specific problem. So you can make other mistakes that year, but I don't want to make any specific mistakes for that goal. So in the past, like one I mentioned was keeping stress under pressure. So I solved that with the dollar stop. One was patience. At one point, I just had a hard time. I went from day trading, market making to position trading. When
Mhm.
your holding period is, a minute and a half to like you're trying to hold for 6 months, it takes some adjusting. It doesn't come so easily.
Yeah, I'll
Yeah.
put in the clutch to change those gears, huh?
Yeah, exactly. So one year was all about patience, and even if I was going to have to give up gains, it was forcing to stay in. And last year and even to this year, one of my real key focuses has been trying to smooth the equity curve on those drops and
Mhm.
selling into kind of. I went the other way with patience. I went a little too patient, so I had to kind of, now my focus is dial back the patience on stocks that aren't showing incredible characteristics of strength. Don't fall in love with everything type of idea. So each
Mhm.
year I pick that one goal because I think really, I mean, trading seems so simple on the surface, but when you get down to it, there's all of these different components of the strategy. There's mindset and risk management and when to buy, how to sell, how much to buy. Each part, if you get any of those like parts of the equation wrong, it could have a real dramatic negative impact on your trading. So I figured if each year I can get a little closer to perfection on each part of the system, ultimately you become a better investor. So that's kind of each year I pick that one goal. It's kind of like a New Year's resolution, but it's one that I really stick to for the whole year and I really try and focus on.
Mm.
So what are some of the strategies that you're trying to use? I mean, cutting your laggards and things like that. But are there any other kind of specific strategies that you might be trying to use to try to say, I'm going to hold this many stocks and try to let them test the 50-day moving average during kind of normal corrections, and these others, maybe I'll half of them I'll try to sell at 20%, and anything like that?
I said to myself, the leaders will break out first. We know that. That's what makes it a leader. They break out first and they'll tend to top last because they're leaders. So rather than trying to kind of use a technical sell signal for the leaders on the leaders themselves, I basically look at the market as a whole. So when the entire market is overbought, or let's
Mhm.
say there's extreme upside breadth, then I use that to go around to start hedging things. I'll either sell my weaker stocks or maybe buy some puts to hedge my strongest stocks. So rather than trying to get the signal from the stock itself, which tends to fail with the strongest leaders because that's what makes them a leader, I use the market as a whole to hedge. So when even like the old saying, even when turkeys can fly, like
In a
Yeah.
a
windstorm,
windstorm, when
right?
even like the junk, when everything is hot and every measure you can look at for breadth is at the upper echelon, and you're the number one, indicators when you feel amazing, when you start
Yeah.
browsing the internet for places to vacation or new cars to buy, when that indicator flashes, okay, I need to buy, I need to buy
Yep.
some hedges and stuff like that. So using the market as a whole to hedge is one of the techniques that I've been using, and that's what helped me kind of really hedge into what were very strong markets during the kind of holiday period just recently.
Mhm. And just out of curiosity, because I know that there's a lot of different ways to hedge, right? Some people
Mhm.
will use the market indexes, inverse indexes, use futures, kind of
Yeah.
matched up with the delta. So Chris Gessel was actually our guest last week, and that was kind of his whole thing about different ways to hedge. What is your preferred way of hedging when things get a little bit out of
Yeah.
out of bounds from their normal areas?
I think before the index, I mean, it depends the kind of portfolio you're running, first of all. But if you're like concentrated to a few leaders, I personally find hedging with the index can be a little dangerous because
Yeah.
sometimes your leaders can take a real hit,
Yep.
and Microsoft's acting well, and so the Nasdaq doesn't really kind of fall, so your hedge doesn't work. Same with the inverse. So
Would
I
have been
don't like.
disastrous last year.
Yeah, you lost two ways. That's a big risk.
Yeah.
Like I when I was on the desk, I used to be with a guy who was a spread trader, and we used to talk, and their worst nightmare is kind of news that pushes the spread the wrong way, and they have size on and they can blow out. So like early, and I saw a bad example of that. So I had an early kind of example of making sure your hedges really match up properly because it could be dangerous. So I don't personally like selling stock because again, my whole goal is really finding those leaders and getting positioned. So I kind of feel like taking stock off kind of works against my ultimate goal. So I just kind of came to the conclusion of, hey, if you have this really big gain, you're doing great. If you can find reasonably priced put options, yeah, you give up part of your profit. It's kind of like, you buy insurance for your home. If your home doesn't burn down, you're not really upset about it. And if the stock kind of just keeps going up, you have the extra profit. If it does have a hard break like we had, well, you've eased the pain and you've hedged part of that drop, and you can be more aggressive on the pullback. So that's my preferred way, but there's many ways, like you mentioned, to do it.
hmm And I also just wanted to kind of touch base on kind of your thinking of tackling one issue at a time.
Yeah.
Um, Bill O'Neill, did have for his portfolio managers, of course, Bill O'Neill was the founder of Investors Business Daily, and he had sometimes 7 to 10 portfolio managers, and a lot of times he would make them go through the post analysis process,
Mhm.
and kind of come up with their rules. What is it you're going to work on for this next time? Um,
Yeah.
Mike Webster famously one time did like 17 pages or something of what he was gonna work on, and Bill was like, "Whoa, whoa, whoa! I wanted like 1 page, because I really wanted this to be focused." So of course, Mike went back and
Yeah.
single space, took off the margins, did 9-point font and everything like that. But Bill's point was, sometimes you need to kind of you need to focus, number one, because if you're going on too many different things, you're not going to be focused on one thing. And a lot of times what's really tripping you up comes down to 2 or 3 things that really kind of messed you up, and if you can fix those, you can get so much more bang for your buck, as opposed to, okay, let me try and be perfect in everything. It's
Mhm.
sometimes just really narrowing it down to a few things. So I really like that process, Matt.
Yeah, and I really put a premium on simplicity. Like when
Yeah.
I started, like I mean, Bill was the first book I really read on investing, but then I got deep into technical analysis. I'm a CMT like Arusha, so then I got really into the weeds of indicators and all that. But eventually, especially I think kind of being a market maker and just then focusing so much on price action and trying to
Mhm.
read like the major buyers and sellers, and that gave me a different spin on things. And so I kind of slowly went back to just really like first principles and being very simple. And I think the markets are so unpredictable. There's so many kind of things that can come out of nowhere and have these big. If you're simple, it allows you to react a lot quicker. If you have
Mhm.
this really complex formula, like maybe it's slightly more effective, but in the heat of the battle, are you going to be able to really implement it? I mean, already I personally find being heavily invested with many names, it's hard to react on one of those days where things are breaking and there's earnings and there's news, and is your stock affected by that news? So I think bringing down the simplicity pays, has a lot of benefits in different ways, and especially in such an uncertain, unpredictable type of business. I think simplicity is extra important.
Mhm.
Yeah, and so I mean, I'm immediately thinking like one of the kind of the things that I've been working on for a while is just the pullbacks, buying on pullbacks. Yeah, Charles Harris has always been so good at that, and some others are. And either a lot of times, either you're really good at buying breakouts, or you might be better at buying pullbacks. But it takes a number of years. But I think after a number of years, I'm getting a little bit more comfortable recognizing that, hey, this, even though it's a bad break, this actually might be an opportunity in the near future to actually initiate a position instead of just removing it off the radar. And it's just that keeping it simple, right? Looking at enough examples, kind of like what you were
Mhm.
talking about before, listening to Bill O'Neill over and over again. After a while, you see enough examples that you start getting a little bit more confidence that this could actually hold instead of really breaking.
Yeah, and I think also you have to put yourself in a position to win as well, because it's a interesting business because you have to you know preemptively prepare yourself for the situation that's coming up. If you think there's going to be a bad break, but you don't take any of those profits, you don't
Yeah.
prepare to protect
Yeah.
your equity curve. Well, how are you going to buy when you're under significant drawdown? You're already fully invested. You're already on margin. You can't. So if your goal is you're looking at all of these stocks and they're all extended 40% from their 10-week average, and this is typically where they start to correct, but you don't take anything off. And this is a problem I had for years. Like you want to buy on the 10-week, I'd always be selling on the 10-week because just
Yeah.
about the time it get
Yes.
back down to there, I'm near my average cost or I'm freaked out because everything is breaking down. And so, you have to kind of, plan ahead for saying like, okay, this is where we are. If we get back down to that 10-week, will I be able to buy if everything drops? And most of the time, if you're honest with yourself, the answer is no. That's the answer. You don't want to believe it because you don't want to sell your stock because you're feeling greedy. But the answer is no, I won't be able to buy down there if I don't take any profits. So, the whole plan has to work together. I think that's where a lot of people get tripped up in trading, and they can do really well in one period, but then get really hurt in another. Is that the whole system is interrelated. You can't be a good buyer but not be a good seller, or be a good buyer and seller and not have good risk management, or not have any kind of other psychological tools. If there's any kind of one critical error in your process, at some point in the cycle, it's going to bite you. So I like understanding that's, and that's why, again, simplicity, there's enough stuff going on. If you're going to get really complicated with all of your models and that, it gets difficult to have to execute in real time.